Hey there and welcome back to the channel. In this video, we are going to learn about moving averages, which is a simple tool that you can use to take your investing journey to the next level. Now, just a disclaimer, this is not any sell or buy recommendation. We're just trying to learn about a powerful tool which can help you decide when to buy and when to sell, and we'll be referencing this book over here, Technical Analysis Explained by Martin J. Pring, and over here there's a chapter, that's chapter 11, which is about moving averages. So again, the way that we're going to approach this topic in this video is going to be a slightly different way, and my aim for you is to develop grip. Now, what is grip actually? Think about it in this way. Let's say you want to climb something up, okay? It could be a mountain or it could be out of a well. Let's take it that you want to climb out of a well. Now, let's think about two scenarios. In one scenario, with every effort or every step that you're taking, you have grip and you keep progressing upwards. The second thing is like you try to move upward, but you keep slipping down. In other words, you don't have grip. So that's the difference which I want to bring about in this video. Again, that's my aim. Let's see how it goes. So I want to help you develop grip, and for this, as we keep working with this video, I'll be coming in between once a while and take a look at the timestamps below, so you can move around in the video to different sections, and I will keep thinking from a first principle standpoint, from a common sense standpoint about the thing that we are learning, and we'll come up with interesting questions which anyone can come up with without knowing anything about this topic. And then we come into the details in the video where we try to learn this in depth and in a very simple manner, because we don't want complication. Like, who wants complication, right? So we learn in a simple manner how we can use this to apply this in our investing journey. So let's get started. So as I said, we're going to work on a checklist and then we go into the details. And for the checklist, we'll just use common sense and things that we already know. So in this way, we will be activating our natural curiosity, and we will be constantly trying to connect whatever new we are learning to things that we already have. And we will be using the simple checklist for this. So let's get started with our checklist. Alright, so we are going to learn about moving averages. So this is something that we already know from the topic of the video. Okay, so that's pretty straightforward. Now, what is it that I would be first thinking about when I consider learning this? So again, we know that it's in the context of investing, and again, just a quick disclaimer, I don't trade, I like to do long-term investing. So we can use this in this context as well. So we will be exploring moving averages primarily in the context of investing in this video. So again, we are trying to connect to our natural curiosity, and whatever new we are learning, we want to learn it so thoroughly, and for that we will be constantly connecting it with things that we know, and we will be generating answers from this topic to questions that we can naturally generate from our curiosity. So what are some questions that I would have? So one question definitely would be, what is this moving average, and why probably should I learn it? Because I have other better things to do probably. So why should I learn it? Or in other words, what's the potential upside or benefit that I can get by learning about moving averages? So I'm sure you would be agreeing that these are natural questions that can come up from your inside when you try to learn about moving averages. So let's see what it is and why probably we should learn about it, and what's the potential upside. So why should I, as an investor, try to learn about moving averages? It's always good to start with the why. So why should we learn about moving averages? Moving averages help you to decide when to buy and when to sell a particular stock, okay? And always remember, when you buy and when you sell will determine your returns. So learning about moving averages will help you improve your returns. So that is point number one. And the second most important point is that it's easy to learn and implement decisions using moving averages. Now, if it were very complicated, then probably there's no use learning about this. But the good news is it's pretty easy. Now let's take a look at a few examples to get you interested. So over here you have the chart for Paytm. Okay, now what can we see in this chart? So again, more of this later, but over here the blue line over here is one moving average, okay, which is plotted for a 10-week period. But again, as I said, more of this soon in this video. And the black line over here is another moving average, which is plotted for a 30-week period. Now notice over here, if you knew about the moving average, it will give you clear signals that you should not be buying in these downtrends. Because let's say you bought over here and notice that the price is falling down and down. Okay, so that's why the trend is your friend, technical analysts say. That's the same case over here as well. So you have a downtrend, and over here also you have a downtrend. But when you take a look at the individual price fluctuations on a week by week basis, you can see it's going up and down. Okay, so that's why moving averages help you when not to buy, and it also gives you clear signals to sell. For example, over here you have a clear signal where the shorter moving average is going below the longer moving average. And again, more of these details will be discussed soon in this video. But over here, I'm just getting you interested. We're just nailing the why part. So notice the moving average gave us a clear sell signal over here, because after this, notice what happens. The price keeps falling and falling, and it reached this level over here. Okay, so you could have prevented this fall by noticing this signal and exiting at this point. Okay, and the other good thing is it also gives you a clear buy signal, which is over here. So notice the 10 weekly moving average is going above the longer period moving average, which is the 30 weekly moving average at this point. And this is a strong buy signal, and I'm hoping that in the days ahead this will go up and up. Now let's take a look at another interesting example. So over here we have Zomato, and notice by just using moving averages we could have identified this buy signal where the shorter moving average, which is the 10 weekly moving average, has crossed the longer one and has become above it. Like notice over here black is above blue, but over here blue is above black. So this over here is a clear buy signal, and then after this notice that the price has been going up and up. So again, these are just a few examples to get you interested. Now moving averages, especially these type of crossovers, works very well in turnaround stocks. And what do I mean with turnaround stocks over here? Notice for Zomato, it's the price has been going down, the trend has been downtrend over here, and then over here you can see it's been turned around to an uptrend. And for Paytm also you can see over here, since this time it's been a downtrend and then an uptrend has started over here. So all of this was just to get you started and just to nail down why it's very helpful to learn about moving averages and why it's simple and easy and it can actually be executed. So we've got a good understanding of what moving averages is, and we have also seen the potential upside that we can get by learning this. Now what would be the next thing that I would want to know when I consider learning more about moving averages and going deeper into this? So again, what would come to my mind is this really easy? Or is it something that I can really apply? Because if it's something very complex, then I would not be able to use it in real life and I would be wasting my time, right? So is it really easy and really can I use it? Okay, so let's think about this in the next part. So is it really that easy and will it always work? So when we have this question in mind, it's important to always remember that technical analysis for investing, and again I use this for long-term investing, so you can use it for short-term trading as well, but I don't have experience in that. Personally, I prefer long-term investing, and again the point I'm trying to make over here is technical analysis is always probabilistic. Okay, so it'll help you identify high probability sell and buy signals. Now, why do I mean that it's probabilistic? Let's take a price pattern. Let's say this is the movement of a price. Let's say we're just plotting, let's say the closing price of a stock. And if we plot the moving average, probably it would look something like this. Okay. Now at this point over here, we are having a valid crossover and it's a clear sell signal because notice from this point onwards, the price has been dropping as time goes on. Okay. So this over here is a valid crossover. But let's take another price pattern. let's say this is the price pattern of another stock. And if we plot the moving average for this particular stock, it could look like this over here. And at this point, notice over here, we are having a sell signal. Okay, over here we are having a sell signal where the price is going below the moving average, and then you can see that it's falling. But then soon after, we are getting a buy signal where the price is going above the moving average. So this is the moving average and the price is going above it. So this probably would be an invalid signal. Again, that this would be especially true if the time period over here could be just a day. So maybe you're getting a sell signal, let's say this is day 1, and in day 3 you're getting a buy signal. Okay, so this over here, these type of scenarios where you're getting opposing signals frequently is an invalid crossover, or we call it a whipsaw. Okay, so again, more of this soon in this video, but over here, all that I want to bring to your mind is you should always have this in mind that whenever you're using technical analysis, it is probabilistic in nature. Okay, but then that's not the end of the road. Now, why is that so? Just because it is probabilistic, it does not mean that we can't use it, right? The reason for that is there are ways to increase the probability. Okay, so there are ways, we'll discuss about these in this video. For example, you can use the volume indication along with a price crossover, etc., but more of that in the later part of this video. So there are ways to increase the probability to get a higher chance to make a right decision. Secondly, you don't need to act on every stock, and there are multiple reasons for that. The primary one being that the money that we have is limited. Okay, so you don't need to act always on every stock's crossover, right? So you can identify the scenarios where you have a high probability, and you can carefully select those high probability ones and act on them. In this way, by making an informed decision, you can maximize the probability of getting higher returns. So basically, learning about these moving averages helps you be rational, and it gives you rationality to the way that you respond to various fluctuations in the price of a stock. Okay, so always remember, technical analysis is probabilistic in nature, and because of this, we should have a weight of the evidence approach where we use multiple things which are simple, but then we try to patiently study and wait for occasions where we have multiple evidences which indicate that our decision is right. So again, multiple evidences could be that a moving crossover happens, a moving average crossover happens, and then along with that probably a trend line break happens. Again, we'll discuss all of this in this video, but over here I'm just getting you familiarized with some things. Okay, so the approach over here is that we are trying to build a weight of the evidence approach where we use multiple pieces of evidence like a detective to arrive at decisions which have a high probability. Okay, so again, another thing was we discussed a high volume along with the moving average crossover may even give more evidence to the decision that we want to take. So we are progressing on our journey about learning moving averages. So far we have seen that probably it's beneficial and probably it's not that difficult. Now, what would be another question that you may have? So let's get back to our checklist. Alright, so I know what moving averages is, and probably it's not that complex. So again, what are the different types of moving averages? Like, is it possible that there's just one type, or are there different types? So again, this would be something that would be pretty interesting to know. So far, we have not covered the basics of what a moving average is, what are the different types, etc. We just thought about why we should learn it to ensure that we are spending our time, which is limited in nature, on things that actually can make a difference to the way we live, right? And to our goals. So again, so far we have just done some groundwork. We have learned that probably learning about moving averages is a good decision and it's easy. And we have also addressed the fact that whatever we learn over here is probabilistic in nature. Now let's get to the basics. And when we learn basics, let's combine them with applications to make our learning as close to applying knowledge as possible. So while some theory is needed, let's club it with applications as we go on in this video. And in this way, we will try to make our learning actionable. So that's our aim. So let's get started first with trying to understand what a moving average is. So let me make some space over here. So we are trying to understand what a moving average is And to start with, let's talk about the simple moving average. Okay, so let's take an example. So over here, we have the chart for HDFC Bank and we have plotted data. You can see over here on a weekly basis. So you have 1 week over here. So every candle over here represents the price fluctuation of this particular stock for a period of 1 week. Now again, let's take just a minute to clarify the basics. So whenever you're reading a chart over here, you will see these type of candlesticks, and in every candlestick, you can see there is a particular color, which is either green or red. And then you have a time period selected, which is what I mentioned over here, is in this case, it's 1 week. Okay. So you have a green candle over here and you have a red candle over here, and the time period over here is 1 week. Now you can change this time period to 1 day or 1 month, and traders use it even in a 15-minute basis probably. Okay, but again, we are over here focusing on long-term investment. So I have a 1 week period over here, and what do these candles mean? Let me just quickly explain that. So over here, you can see for every candle, you have a box, which is the body of the candle. Like for example, you have this part over here, which looks like a box, and then you have lines over here, which is the wick. Okay, so again, the terminologies don't matter, but let's just quickly understand what the meaning is. Now, if you have a green candle, it simply means that the closing price is greater than the opening price. Like let's say a stock opened at 100 rupees and it closed at 200 rupees. So the closing price is greater than the opening price, or people made a profit. Okay, so that's why it has a green color. And if it's the opposite, that is, if the opening price is greater than the closing price, then we would have a red candle. So we are very clear with the color of the candle. Now, what do these areas in a candle mean? So this would be the highest price that this particular stock has reached for the time period selected, and this would be the lowest price. Okay, and this over here would either be the opening or the closing price, and this over here also would be the opening or the closing price. So for a green candle, this would be the closing price and this would be the opening price. And notice for a green candle, closing is greater than opening. So again, as you go up on the y-axis, the price increases, right? So that's why we would have the closing price over here and the opening price over here. So this would be for a green candle. And if you're dealing with a red candle, it would be the opposite. So again, over here you would have the opening price, over here the closing price, and this is the highest price and this is the lowest price. All right, so we were just covering the basics about colors of candle and the time period selected in a chart. We will soon see how you can plot a moving average on this chart. So I'll show that to you in this video itself. But over here, let's proceed with understanding first what a moving average is, and we will tie it to an application which is to understand the trend of the price of a particular stock. So let's continue with this. So we are trying to understand what a simple moving average is. So as the name suggests, the simple moving average is just the average, or simply the average of the closing price of the last X time periods. So you can plot a simple moving average for 30 days or 30 weeks or 10 days or 10 weeks, etc. So it can be done for any time period, and it can be done for any number of those time periods. So what this actually plots is the average of the closing price of the last X time periods. Okay, so that's how this is generally created. Now you can change this, but I'm just covering the general scenario. Okay, so the average of the closing price of the last X time periods. Now what would this mean? So notice over here, this blue line over here is the simple moving average, and over here we have weeks. Okay, we have selected weeks. So every candle over here represents 1 week's data, and then over here you can see there is a 30. Okay, so this implies that this is the simple moving average created for 30 weeks. Okay, so that's this line over here. Now how would this line be plotted? Now for that, let's just think about one point on this line, and then you just connect all the points to get the line, right? So for example, this point over here on this line would be the sum of the last 30 closing prices, and it's on a weekly basis. divided by 30. So that's the average, right? Average means sum divided by the number of items. So, and over here, because it's a 30 time period moving average, that's why we consider 30 prices. We will add all of those 30 closing prices for the last 30 weeks, and then we will divide the sum by 30. So that's how we get the average, and that would be this point over here. And in a similar manner, when we get to the next point, we would be dropping the first value. Like for example, we have week 1 up to week 30 for this point over here, and then when we get the next value, we add a value, we drop this value, and we take these values, we sum it up, and we divide it by 30 to get this point. So in this way, we will get various points, and then we will just connect it, and in this way we will be able to form the simple moving average line. Alright, so we have learned what a simple moving average is. So how do you plot a moving average? So you can just go to tradingview.com, okay, and then you go to products, you go to super charts, and you can just close this. So you have a chart for a particular stock over here. Now let me just take an example. Let's say we take Zomato. So you can type Zomato, you'll get the stock over here, you can click it. So this is the first step, and then you come to indicators over here, and you can just type simple moving average. So then you click on simple moving averages. You can take any one. So let's just take this over here, and you will have to sign up for it. Remember, it's free to sign up. You can use up to 2 indicators for free on Tradingview. So let me just quickly sign in and come back and show you the remaining part. All right, so we are back. So you can click on indicators, and you can just say SMA, okay, moving average simple. So you click on this, and it will get added over here. So you can see something has come over here. And then so what you can do is, let me just remove this. Okay, so we'll have only one line. So now this is for a weekly period, so the time period is over here, and this is for 9 weeks. Now to change this, you can just click, you hover over it, you will get this bar over here. Then you can click on this one, and you can change the length. Like let's say you want to have a 50-day one, so you click on 50, you add 50, you type 50 over here, and you click OK. And this is your 50-day simple moving average. Now it's very important that we connect everything that we learn to some application. Okay, so what is the purpose of a moving average? Let's talk about 2 purposes over here. First, to identify the trend. So that's this part over here, identify the trend. And secondly, the most important use or application of a moving average is to identify a change or a continuation of a trend. Okay, so this would help us to act on what is happening in the market. So let's think about these 2 things over here. Okay, so again over here I have a chart for SBI card. Okay, and notice the price is fluctuating, and I have plotted over here for a time period of 1 week, and this is 20 such weeks. So this over here is the simple moving average, and we take into consideration 20 weeks to plot every point over here. Okay, now notice that a moving average changes the fluctuations that we see on a price trend into a smooth trend. So again, the line over here is a smooth line, as you can see. Okay, for example, notice this area over here, between this over here and this over here, there is a clear downtrend, or the price keeps going down and down. Okay, but when you take a look at the prices, the individual prices, you have downs over here, then you have green candles, red candles, green candles. Green candles means that the closing price is above the opening price. So you have fluctuations, you have things going up and down, which is normal when it comes to prices of traded items, right? So the fluctuations are changed into a smooth line because of the moving average. So this is the first thing that we have noticed over here. It identifies the trend by making the line a smooth trend. For example, over here we were able to identify it's a downtrend. And again, just quickly mentioning it, generally try to avoid buying things in a downtrend, because over here, let's say you notice that the price was once over here, and then there is a downtrend, and let's say this is the place in time where you are. Now, because we are still in a downtrend, there is a possibility for the price to go even further down. So that's why generally avoid buying in a downtrend and wait for the downtrend to end. Okay. So again, that's action, that's actionable knowledge. So the moving average helps us to identify how the trend of the stock price looks like. Is it in a downtrend, or is it in an uptrend, or is it just going sideways? Sideways means it's looking almost like a horizontal line. So that's the first application. And the second application is we can use a moving average to either identify a change in trend or a continuation of a trend. Again, we have this SBI cards chart over here. Now let's take a look at this part. Where do we see a change in a trend and a continuation in a trend? And then let's think about how we can act upon this once we identify it. Okay. So over here, notice you can see a change in the trend. In this part, the moving average is going up. So this is an uptrend, right? And over here, it's a downtrend. So you can see there is a change in the trend from an uptrend to a downtrend. Okay. And again, typically when this happens, and we will see more of how to identify it, basically the change in the trend, as you see over here, would take some lag. And again, we'll discuss this soon. So the actionable part would be whenever the price crosses the moving average, it probably, when it crosses downwards, it's a sell signal because the price can go further down. So it's better to sell over here rather than selling over here, because you will lose less money, right? So again, that's one of the applications. So again, we are just building things one step at a time. So over here, using a moving average, we've been able to identify a change in the trend. So an uptrend changed to a downtrend. So that's this part over here. Now, what about the continuation of a trend? So that's something that you can see over here. For example, notice that the price went up, it touched the moving average, and then it bounced and it again fell. It could not break this, right? So the price tried to break it, it touched the moving average, and then it again fell below it. So there is no change in the trend over here. So when this happens, it probably again indicates that you could sell whatever you have, because it's not able to break this over here and go above it. Okay. So more of that soon. But over here, all that we have learned so far is that with a moving average, we've been able to identify the trend. And secondly, we have been able to identify a change in the trend, which is what is happening over here. And we have also seen where a change has been attempted, but it didn't work out, right? So it bounced off the moving average. So this is a continuation of the trend. So these are a few interesting things that we were able to learn by just looking at the simple moving average. Now let's come to the next point, which is that there are actually three main types of moving averages. The three main types of moving averages are the simple moving average, the weighted moving average, and the exponential moving average. Now let's try to think about these things. So we have seen the simple moving average is just the average of the X time periods. Like for example, if we take a 30-week time period, we will sum the closing price for those 30 weeks and divide it by 30 to get a particular point to be plotted in this line. So we have seen this already. Now, one of the disadvantages of this is that it's a lagging indicator. Like for example, let's say the price went down. Now, the moving average will take some time to reflect this. Okay. So if this is the moving average, it will take some time to start sloping downwards. So it's a lagging indicator. And that's why these two are helpful, because it gives more weightage to the recent prices. Now, the weighted moving average is the most sensitive, but typically we use an exponential moving average. But the idea is the same. Both the weighted moving average and the exponential moving average give more weightage to recent prices. Like for example, if we are considering a 30-week time period, then the last week has greater weightage than week number 1. Okay. So recent prices or recent periods have greater weightage when it comes to a weighted moving average or an exponential moving average. Now, the way that this is calculated is both the maths behind it is a bit different, but again, I think we don't need to go into the complications. Now, in the book which I mentioned, there is an example which shows how you can calculate the exponential moving average. Now again, if you're interested, we can discuss that probably in a different video, but over here let me keep things simple. But the idea to realize is that the purpose for these two is that it turns faster when the price changes. It's less lagging than the simple moving average because it gives weightage, higher weightage to recent prices. So that's the funda behind the weighted moving average and the exponential moving average. Okay, so these turn faster as the price trend changes. So again, always we would want to act upon changes faster to make more money, right? So that's why these are very useful. Now, because we have discussed that there are these three types of moving averages, it's natural that you may have a question. So which one should I use? Which one would be better in different scenarios, etc. So we will come to that soon. But again, you can always try a combination of moving averages as well, which is a good method. But we will discuss more of that in the coming part of this video. So again, we are learning all of this because ultimately we want to be able to use this. So the next thing that I would like to add to my checklist, and again, these are things that I think before I go into the knowledge bank, again the part of the video where we discuss concepts, because if I just get bombarded with things, I won't be developing grip. Again, remember the analogy which we discussed in the beginning. So I want to keep developing grip and I want to get out of this well. So again, let me add something to the checklist and then let me develop my knowledge. So the next thing that I'm going to write over here is, how do I make decisions using a moving average? Now again, when it comes to investing, the decisions are, how do I decide to buy a stock? How do I decide whether it's time to sell a stock? And how do I decide whether probably I should be holding the stock that I have already bought? So these are decisions that are to be made continually when it comes to investing. So how can I make use of moving averages probably to make these decisions in a more rational manner? Let's see more about that. So how do we make buy or sell decisions using a moving average? So let's come to that part. And for this, we'll cover these 3 points together. First of all, the point is that a moving average acts as a resistance or a support. Secondly, what's the deal between a price crossover and a moving average? And thirdly, we'll talk about whipsaws and identifying a valid moving average. So let's come to these 3 things, okay? And to start with, let's talk about a resistance and support. So first, what is a resistance and support and how do we use these in application? So let's say this is the way the price of a stock moves, and if I just join the highs over here, you can see that it forms a line. And this is what we typically call a resistance line or a resistance trend line. Okay. So again, it means that typically the price will not go above it for a few time periods. So again, the next time it comes, there is a chance that it will not break it, rather it will bounce down. So that's what we call a resistance. And similarly, if a price is going down in this manner, if we connect all the lows, you can see there is a support formed, which means that it's not breaking and not going below it. So this is what a resistance and a support is. And this is something we do when we construct trend lines, but maybe we can discuss that in a different video. But over here, it's sufficient to discuss this much to understand what a resistance is and what a support is. Now over here, we constructed this resistance by joining the high prices over here. Similarly, this support was constructed by joining the low prices over here. Okay. Now, the point over here that we are discussing with respect to moving averages is that moving averages also act as dynamic support and resistance lines. Okay, so they don't look like a straight line, but they also act as a resistance line or a support line. Now, let's take a look at a chart and try to understand this in a better manner. So over here, again, I have SBI cards and I have plotted the exponential moving average for a 30-week time period. So that's this black line over here. Okay, so you have 1 week over here, you have exponential moving average over here, and you have 30 over here. Okay, now notice over here, the moving average is acting as a support because the price tried to go below it, but it bounced over here and it again continued to remain above the moving average. So over here, the moving average is acting as a support. Okay. Now, how do you act upon this knowledge? Like, let's say you're considering whether you want to buy more of SBI cards or not. So probably once you see that the price has bounced on the moving average, you can even buy more because it has not fallen to a downtrend. The trend has not changed. So on the contrary, like let's say this is the time period where you are at and you're trying to decide whether to buy more of this stock or not. So I would say it's better to wait for a few time periods and see whether it's breaking the moving average or whether it is bouncing back. And if you see that it's bouncing back, probably it would be a good time to buy more of this stock, or if you already have this stock, you can hold it because the uptrend is preserved. Secondly, notice over here, the moving average is acting as a resistance. The price is trying to go up. It's trying to go up and break this, but it's coming till here, it's approaching it, and then it's falling again back. So over here, the moving average is acting as a resistance, and this would be probably a good sign to sell. Okay. So again, you are already in a downtrend, and if you see that the moving average is approaching, probably you can sell as close as possible to the moving average. And again, you can't have perfection. Like you can see it's approaching it, but it's bouncing off the moving average, which means that it's acting as a resistance. It's not able to reverse this downtrend into an uptrend. The price has not been able to break the moving average and go above it. That's what we can see over here. So we have seen an example where the moving average is acting as a support and where it is acting as a resistance. So again, notice in an uptrend, the moving average is acting as a support, and in a downtrend, the moving average is acting as a resistance. Now we will discuss more about crossovers, but over here, for example, you can see after a downtrend, the price has crossed the moving average. This probably would be a buy signal because it's crossed this resistance. The moving average was not able to provide resistance and the price crossed above it. But again, price crossovers is something that we will discuss soon. Over here, it's sufficient to focus on the moving average being a support and a resistance. All right, so let's proceed. Now the next point that we discuss is price crossovers. This is a very important topic. So first, let's try to understand what is a price crossover. So over here, we have seen that this line is acting as a resistance. Now let's say the price over here, instead of bouncing on the resistance, let's say it's breaking the resistance and going up. Okay, or over here, we have seen that this line over here was acting as a support. Now let's say the price, instead of bouncing over here, is crossing down. Okay, so it's crossing the support over here, it's crossing the resistance over here. So these type of scenarios is what we call a price crossover. Okay, and we have also discussed that a moving average also acts as a resistance and support, and when the price crosses the moving average, we can say that a price crossover has happened. And typically when a price is crossing in the above direction, like it's breaking the resistance and it's going above, probably it's a buy signal because whatever is going up tends to go even further and further up, and when it goes down, it's a good sell signal over here because whatever is going down has a tendency to go further and further down. Okay, so again, let's take an example of a chart to try to understand this. So we have SBI cards over here, and we have plotted an exponential moving average, that's this black line over here, and we have used a 30-week time period. All right, now over here, notice the price is above the 30-week exponential moving average. Can you see that? So this is the exponential moving average and the price in this period is above it. And over here, notice that the price over here has crossed the 30-week exponential moving average. So for example, the price was above it at this point. Can you see it? At this point, the price is crossing it and then it's going further down. So the price has crossed the 30-week moving average, exponential moving average, and this would be a sell sign because what tends to go down tends to go further down. So it's better to sell over here. You could have sold at this point, which is close to 1000, instead of it the price going to this range over here, which is 680 kind of. Okay, so you can avoid losing this money over here by noting this price crossover and taking action by selling at this point. All right, now notice after the crossover, for a period, the price is below the exponential moving average, the 30-week exponential moving average. And then later you can see there is a buy signal over here when the price goes above it. Now, again, more of that soon, but what we have learned over here is that when you notice a price crossover, when it is a crossover towards the downside, it's a sell signal. When it's a crossover towards the upside, you can take it as a buy signal. Again, all of this is probabilistic in nature. You have to try to build more and more evidence to ensure that you have a high probability that your buy or sell decision is the right decision. All right. Now, again, we have seen there is a price crossover over here where the price went above the 30 weekly exponential moving average, and that gives you a buy signal. All right. Now, so far we have discussed two aspects. The first aspect is the slope of the moving average changing. Like if the slope looks like this, it's an uptrend. If the slope goes like this, it's a downtrend. And the second thing that we have discussed, so this is the first thing that we have discussed. And the second thing that we have discussed is the price crossing the moving average. Like for example, this is a moving average, this blue line over here, and you can see over here, etc. Right? All of these places, the price is crossing the moving average. Can you see that both of these are different? Like for example, notice the price is crossing the moving average over here, and the trend over here is down. The trend over here probably is up, down, up, like this. Okay. So there are these two aspects. Now, which aspect is an indication for the change of the trend? Because we want to identify the trend to make buy and sell decisions. Now, which one should you use? Should you use the change of the direction of the simple moving average, or should you use the price crossing the simple moving average? Let's think about that. So when it comes to the simple moving average, the change in trend is measured by the price crossover, not the change in direction. Why is that so? Because this happens soon. We want to act fast. This is a lagging indication, so it will take time for this to shape up. So this can be used as a confirmation, but we want to take action, right? So the action should be based on the price crossing the moving average. Now let's take a look at this chart over here, which is for Nifty 50 index. Now notice over here, you can see the price over here is above the 50-day simple moving average. So over here I've used a 50-day simple moving average. Okay, so that's this blue line over here. So the price over here is above the 50-day simple moving average, and over here the price is getting crossed. The price is crossing it. You can see that happening over here. Okay, but when it comes to the change in direction of the blue line, okay, notice that it's happening only here. Even though the price crossed the simple moving average at this point, the trend over here still looks like an uptrend, right? And the trend is reversing only at this point. So that's why the simple moving average is a lagging indicator. It will take time to change direction, and the reason for that is it's an average. Now average has this property that it is affected by extremes. Okay, so again, you can just plot the average for 30 numbers and then introduce a big number. You'll see that it will pull the average towards it, right? So over here we are seeing a price decrease, but then over here all of these higher prices make the change of the average lesser. Like you have a thousand, let's say you have 1,000, you have 2 times 1,000, and then you have 10 and 20. Let's say these are prices. Now 1,000 and 1,000 and 10, the change over here is huge. But when you take a look at the average, right, over here the average was 2,000. Over here it's 2,010 by 3, and over here it's 2,030 by 4. So as you go from here to here, yes, slowly the average is getting tilted, but you won't get the huge change at this point itself, because these guys will try to pull the average towards them. So because we are just dealing with an average, the simple moving average is a lagging indicator, and that's why you have to take the price crossover, not the change in direction, as the signal for making your decisions. So this is something that you should learn. Okay, so again we have learned that the simple moving average is a lagging indicator. So change in the price trend is identified by the price crossing the moving average, not by the change in the slope of the simple moving average line. All right, so we have learned a few interesting things. Now, earlier we discussed that the exponential moving average turns faster, and even the weighted moving average also turns faster than the simple moving average. So you can see that in the previous part of this video we had discussed that. And so when we compare these two, what should be the indication, or what should be the signal for us to take action, or how do we identify that there is a change in the trend, change in price trend? So that's one thing that we want to discuss now. So that's the first point. And the second point is, how do we make use of a change in the direction when it comes to these two moving averages? So when it comes to the simple moving average, just now with the help of the Nifty 50 chart, we discussed that the change in price trend is identified by the price crossing the simple moving average, not by the change in direction, because it's a lagging indication. And when it comes to the exponential moving average, it's still the price crossover, which is the signal for us to take action. But the difference is that the simple moving average is lagging, but the exponential moving average moves faster. So you can use it along with the price crossover of an exponential moving average. So if these two things are happening together, that is, if there is a price crossover for the exponential moving average, and let's say the direction also has changed, because it changes faster when it comes to an exponential moving average. So if these two things are happening together, you have even more evidence that probably there is a price trend change. Again, remember, we are trying to gather as much as evidence as we can to make decisions which have high probability. All right, so we have learned about the simple moving average, and we have also learned that it's the price crossover which we should be looking for. And if you're using an exponential moving average, we can use these two together as well. But again, this is still the primary thing that we are looking for. Now, the next thing that I want to discuss over here is that when we say price crossover, which is the price that should be crossing the moving average? Is it the closing price, or is it any price? Again, remember, we had discussed these candlesticks. Like this is a candlestick. So let's say this is maybe let me just draw this again. So let's say we have a candlestick. Let's say this is green in color. I'm not changing the color of my pen, but let's say this is green in color. It would mean that the closing price is above the opening price, but this is the highest price. So let's say our moving average is going like this. So is this enough? Like over here, this price has crossed the moving average, though the closing price has not crossed the moving average. So is this enough, or do we need the closing price to cross the moving average? So let's discuss that. So typically we would want the closing price to cross the moving average. And for that, let's try to think about the psychology behind the closing price. The closing price of a stock reflects the positions investors are willing to carry overnight. Okay, so there's more stability for the closing price, and it is less subject to rumors and other noises. So that is why when you want to confirm a price crossover, wait for the closing price to penetrate the moving average before concluding that a crossover has happened. Now let's take a look at a chart and let's try to understand this. So over here, notice when it comes to the closing price is still below the moving average. So the black line over here is a 30-day exponential moving average line, and this candle over here, you can see the wick of the candle has crossed the moving average slightly. Okay, it has crossed it slightly, but the closing price, which would be this price over here, because we have a red candle, right? So this part over here would be the closing price. So the closing price has still not penetrated the moving average line, and therefore this is not enough to be treated as a price crossover. But if you take a look at this part over here, you can see that over here the closing price has clearly penetrated the moving average, and therefore this over here would be a valid price crossover indication. Okay, so we have discussed that usually we have to wait for the closing price to cross the moving average to determine that a price crossover has happened, to confirm it. But again, there is an exception. Like if you have a moving average and let's say it's touched or approached by highs and lows of different candles multiple times, this would indicate that the resistance that we are dealing with or the support that we are dealing with is a strong resistance or support, because it was approached multiple times without being penetrated. So when we have identified a strong resistance and support, even a penetration of it, if it's not by the closing price but just by any price, it would still have greater significance. But I would still suggest that you can play safe, because there are always multiple options. You don't need to act on every signal that you get. You wait till you have a signal which has a high probability to act upon. So again, we have discussed that it's always good to wait for the closing price to penetrate the moving average to confirm that a price crossover has indeed happened. All right, so we have learned some interesting concepts. Now, is it possible that it's so easy? Could there be scenarios where a price crosses over a moving average, but still probably it's not the best decision to either sell or buy based on what we discussed so far? So this would be the next thing that comes to my mind. Again, notice it's natural curiosity, and we are trying to connect whatever we are learning to the real world application of stuff. So let me add this to my checklist at this point. So I am adding over here, will a crossover be always valid? So this is an important question, and probably if no, is there a way to increase the likelihood or the probability to make right decisions? Okay, and again, we have seen in the video that all of this is probabilistic in nature. Nothing is absolute or fixed or deterministic in nature. So is there a way, if every crossover probably may not be valid, is there a way to reduce the noise and to increase the probability that decisions that we make are the right decisions? So let's discuss that in the video. And finally, we come to the point where, again, initially we had discussed that technical analysis is probabilistic in nature. We have discussed that whipsaws are scenarios where you get contrary signals, that is buy and sell signals one after the other. So probably there is a war going on between buyers and sellers, and there is confusion between buyers and sellers. So there is no clear uptrend or downtrend. So that is what we call a whipsaw, right? So when you have buy and sell signals occurring again and again, so you can't rely on those signals at that point. So how do we differentiate between a valid crossover signal and a whipsaw? Or how do we build more evidence, or how can we be more surer or have higher probability when it comes to determining a price crossover? So let's think about that in this part. So over here in this chart, notice I have used a 30-day exponential moving average. So that is this black line over here. Okay, and you can see that I have a buy signal over here because the price, the closing price, has gone above the moving average, and over here I have a sell signal because the closing price has gone below the moving average, and this is just days time period. So I wouldn't want to buy and sell, right? I'm talking about this from a long-term investment perspective. Okay, so that's why when you have a scenario like this, you're dealing with a whipsaw. That is when you're getting opposite frequent signals, you're dealing with a whipsaw, and it's difficult to discern the trend at this point. So how do we deal with these type of scenarios, or how do we increase evidence by using various other things to make a valid decision when we are dealing with a whipsaw? So let's discuss with this. And for this, I have 6 points over here. And again, the thing is that all of these are simple. If it's complex, probably you will not use it, and there's no point in spending time on learning complex things. Or if you are learning something complex, ensure that you learn it so thoroughly that it becomes at least simple for you. Because ultimately, when it comes to action, we will only act upon simple things. So let's get into these 6 simple ways in which we can increase the evidence that we have to differentiate between a valid price crossover and a whipsaw. Okay, so the first point I have over here is wait at least for 2 periods to witness a price crossover. Like let's say you have a moving average, and let's say yes, one candlestick has gone above it. So you have a price crossover over here. So this is the first period, and then wait for one more period to see whether it's sustaining over here or whether it is again breaking down in the next period. So hold for at least 2 periods. And again, typically when you may lose a little bit of profit because you're waiting for this, but that's okay. We are building a valid system, and again, there are multiple scenarios where even after losing this money, you can still make 100%, 200% returns. Okay, so that's still possible. So we just want to be patient. We want to act on signals which have a high probability. So this would be one way to ascertain that it's a valid crossover and not just a whipsaw. So the first tool that you can use is wait for at least 2 periods to validate whether the crossover is sustained. The second thing that you can use is see how much the price has been penetrated. Again, remember, we're just trying to increase our evidence to ensure that we are acting with high probability. So maybe instead of the moving average to be just penetrated above, maybe if it's penetrated a little bit more above, like this would have a higher probability. Okay, so that's the second technique that you can use. And in the book which I described, which is Technical Analysis Explained, they have described a technique where you can draw 2 lines over here, which is 3% above and below it, below the moving average. So instead of treating this as a moving average crossover, you can treat when the closing price crosses the dotted line, you can treat it as a moving average crossover in this scenario. So again, you're just having a higher margin of safety in this case. So that's the second technique that you can use to have a higher probability or to have more evidence of the price crossover. All right. Now the third technique that you can use is you can combine a moving average crossover along with a trend line violation. So when this happens, it's a powerful indicator. Now a trend line is just the line that you get when you connect the lows or highs. And typically you can do by just connecting 2 lows or 2 highs, but probably you'll get a better trend line if you try to connect at least 3 lows or 3 highs. Okay, so that would give you a straight line as we have discussed previously. Like for example, if you have price moving in this way, if you connect these 3 highs, this is a trend line. Okay, so let's say there is a scenario where the price is breaking the moving average and the price is breaking the trend line. So you are having 2 pieces of evidence, and this in general would be a powerful signal. For example, take a look at this chart over here where we are dealing with IDFC First Bank. So you can see that over here the price is breaking the trend line and it's also breaking the moving average. So I have a 30-day exponential moving average plotted, and you can see that this is the trend line which I got by connecting these lows. Okay, so I've connected these 3 lows, and notice over here the price is going below the trend line and it's also breaking the moving average. So when this happens, you have more evidence, and this would indicate that you have higher probability to be right. So for example, this in fact is a valid price crossover. You can see that the price is going down. Okay, so this was approximately what? This was around 90 kind of, or 91, and then you can see it's going down and it's been in a downtrend. You can see now it is somewhere around 74 like that. Okay, and then over here it's back to 80. So this has been a slight reversal. Okay, so the price has crossed over here again. So again, what I mean to say over here is we have more evidence when you see a trend line being broken along with a moving average being broken by the price. All right. So that's the third technique that we have discussed. And again, we're just trying to see how to increase the evidence that we have to differentiate between a valid price crossover and a whipsaw. Now, the fourth thing over here is volume. Okay. So in a chart, you can see the volume. Volume means how many stocks have been traded. Okay. So if you see a crossover with high volume, it has higher probability that it is a valid crossover. So for example, over here, notice in this crossover area, you have these high mountains, right? So it indicates high volume. With high volume, we mean higher than the average volume. So over here, you can see the average volume is in this range, but then this is significantly more than maybe 500-600% of the average of this volume in the nearby period, right? So you have high volume along with the price crossover. So this indicates high probability that it is a valid price crossover. And over here, we know this is crossing in the upward direction. So this means that it's giving a buy signal. All right. So this is the fourth tool that you can use. And again, you can easily plot the volume on any chart software. Okay, so you just need to add volume also as an indicator. Now the fifth tool that you can use is the time period of the moving average. So the general rule is that if you are using a higher time period, it will be less sensitive, and less sensitive means you'll have lower whipsaws, but again you will get signals also in a slower manner. So again, it depends on what time frame you're looking for with respect to your investments. So the time period can be adjusted to reduce the whipsaws that you see. And as a general rule of thumb, if you're trying to observe short-term trends, then probably you can use 10 or 20-day periods. And if you're looking at mid-term trends, then probably it's a good idea to take a look at 10-week or 30-week or 200-day trends. Okay. And if you're looking at long-term trends, then probably you can take a look at 12 months or 45 weeks. Okay. So these are some things that you can experiment with. And especially if you want to monitor the primary trend, then 12 months is a good indicator because it factors in seasonality, because all the 12 months are included over here. Okay. So if you want to catch a downward trend in the market, you can use a 12-month time period to monitor the primary trend as well. All right. So far, we have discussed 5 methods to differentiate between a valid crossover and a whipsaw. Now, one more method is pending, which is multiple moving averages. I'll come to that in a minute. But over here, let's also discuss what if a trading range is established. Now, what is a trading range? A trading range is like if you have these two lines, if you get this line by connecting the highs of a price and this line by connecting the lows of a price, it could be something like this. Okay, let's say the price is going in this manner, or it could be in this manner as well. So there is a range between which the price keeps trading. Now when this happens, it's likely that you will get multiple buy and sell signals one after the other, which could be a whipsaw. So then again, you won't understand it when you get 1 or 2 signals, but then when you have 1 or 2 or 3 signals and you plot, you see that it's between a trading range, it will become obvious. And when you have this, then probably no longer use the indication of a moving average being crossed over, because it will keep happening frequently. So it's clearly a whipsaw, but rather wait for the trend line to be broken. Okay, so wait for the trend line to be broken in these type of scenarios. Like for example, this is the trend line. Now if it goes below the trend line, this is a clear trend line breaking, or over here also, like it can go up and below. Either way, it could go up, or over here it could break down as well. In this case also, maybe it can break down in this way, it would break this trend line, or maybe it can break it in the upward manner as well. So when the price is between a trading range, when you see that this is happening, then probably it's a good idea to not consider the crossover of a moving average, but rather wait for the price to cross over the trend line. Okay, again, we are just using multiple things to build evidence and increase the probability of our decisions. And now we come to the 6th part, which is a powerful indicator. And again, in fact, I used these to show you Paytm and Zomato in the beginning of this video, and you can use this in a powerful manner. So maybe towards the end of the video, I'll also just see and make 3 predictions. No, not a buy or sell recommendation. I'll just mention 3 stocks in which I expect something to happen based on using multiple moving averages. All right, so let's get into multiple moving averages. Now, with multiple moving averages, I mean that you're plotting moving average on different criteria. It could be that you're plotting one moving average for a 50-day period and one more moving average for a 200-day period. That's an example of having multiple moving averages. Okay, and when you have the convergence of multiple moving averages, like for example, the 200-day simple moving average and the 50-day simple moving average. So when this happens, it indicates a narrowing of the trading range, and a narrowing of the trading range generally precedes a sharp price movement. And if you know this, you can try to see the strength of the evidence at hand, and it can actually help you make good decisions which can significantly increase your returns. Now let's take an example. So over here you have Alibaba, okay, and notice something called the golden cross has happened over here, which is when a shorter moving average goes above a longer moving average. So notice over here, you have this black line, which is the 30-week exponential moving average. So notice you have week over here and you have 30 over here and EMA. So that's why this is the 30-week exponential moving average, and the blue line over here is the 10-week exponential moving average. Okay, and notice over here at this point the 10-week exponential moving average is going above, or the blue line is going above the black line. This indicates something called a golden crossover, and typically after a golden crossover there is a high probability for the price to go up significantly, which is what we have seen over here. Okay, so this is a powerful buy signal which you can use, and this is especially powerfully true and can be used powerfully in turnaround stocks. So you can see there's been a time of downtrend and then now it's turning around. And this is the same signal which I showed to you in the beginning of this video for Paytm and Zomato. Okay, now let's take another example. This is UiPath. Okay, and over here notice the shorter moving average went below the longer moving average, and when this happens it's a sell signal, and this is what we call a death cross, when the longer is above the shorter. Okay, so for example notice till here blue line, which was the shorter, which is the 10-week exponential moving average, was above the black line, which is the 30-week exponential moving average, but at this point it has been reversed, and notice the price fall after that. So this happened over here, and you still had 3 weeks to limit your losses up to here, which would be somewhere around $19. But after that it has gone to this area over here, which is somewhere across around $12. Okay, so you could have avoided this loss by selling at this point. So this is what is called a death cross. Okay, and probably in the future for this we will see a golden cross as well. Maybe the stock is doing very well at this point, the UiPath, so its earnings have been slightly upgraded. So those are aspects about fundamental analysis which you can use, but the technical signal would be at a later point. Like let me just extrapolate it. Let's say the company does better and better and sentiments turn in favor of it. Let's say earnings are revised upwards, and at some point the blue line would go above the black line. I'm just drawing this hypothetically. Okay, so this would indicate a golden crossover, and after that it's likely that the price will go sharply up. Okay, so again that's something that you can use in case it happens in the future. All right, so again, what are some of the options that you have when it comes to using multiple moving averages? And this is pretty simple, right? You would agree with me. It's not very difficult to learn. You can easily implement this right after this video. So some of the options that you have is you can use a 50-day simple moving average and a 200-day simple moving average. You could also use a 10-week exponential moving average and a 30-week exponential moving average. Remember, exponential moving averages turn faster than simple moving averages. So probably a good idea to check exponential moving averages. It will give you faster signals. And another technique that you can use is you can use a 25-week simple moving average and a 25-week simple moving average advanced by 5 weeks. So this is another technique described in the book Technical Analysis Explained, and advancing a moving average is just plotting it ahead. Like for a particular period, you'll get a value by adding the 25 weeks and dividing it by 25 weeks. Now let's say you get a value like $25, okay, or let's say $30. So you get $30 for week 1, okay, as per the calculation that we have discussed. So we have discussed already that a simple moving average is just calculating the average for X time periods. So let's say you get this $30 value for week 1. Now you're advancing it by 5 weeks by plotting it on week 6. Like the weeks are plotted on the x-axis, right? So you're advancing it ahead. So in this way, by using both of these, that is a 25-week simple moving average and a 25-week simple moving average, which is advanced by 5 weeks, you can again reduce whipsaws. Okay, so again, this is also pretty similar. All of this, I'll just quickly show you how you can plot this on a Tradingview chart. All right, we're back. So we have Zomato over here. Now let's try to plot the 10-week exponential moving average and the 30-week exponential moving average for this stock. So let's go to indicators and you can type EMA or exponential moving average, and you'll get moving average exponential. So let's click on that and it'll get added over here. Okay, so this for now is for 9 weeks. Now let me change this to 30 weeks. So you come to inputs and length, we'll change it to 30. Okay, so we have this line over here. This is the 30-week exponential moving average line. Now again, you can come to this part, click over here, and in the visibility, in the style part, you can click on this and make this line thicker if you want it to be more thicker. Okay, so this is the 30-week exponential moving average, and in a similar manner, you'll have to go to indicators. Again, you'll have to type EMA or exponential moving average, and you can add it. So you'll get the next indicator, which I already have over here, and in the input, you'll have to ensure that you have a length of 10. Okay, so let me make this visible. So now I have two exponential moving averages, and notice that over here I can see the price crossover happening. Okay, so you can see that's around 15th of May, and again I could have taken a few weeks also to act upon this and still made very good returns. Now again, let's take a look at the volume, which is another thing that we have seen. So you can see over here, how's the volume? The volume has been increasing, and I can see good volume over here. Okay, yep. So again, this is a good indication that this probably is a valid crossover, and this could have given a good buy signal. So we have learned some interesting things about the simple moving average and exponential moving averages, as well as weighted moving averages. Now again, I've said that these are all application oriented things. So let me talk about 3 stocks, and again this is not a buy or sell recommendation, but these are 3 stocks for which I'm waiting, and I'm expecting that probably in the future there should be a golden crossover. So the first one is Vodafone Idea, the second one is Ginkgo Bioworks, which is listed on the New York Stock Exchange, and the third one is Aarti Industries. Now do let me know in the comments, what do you think? Do you think a golden crossover may be possible for these? See you in the next video.